Welcome back to Talk Tickers, your deep dive into cutting through the noise in earnings season. Today, we are focused squarely on the third quarter 2025 results for Bridgewater Bank shares. That's ticker BWB. Now, for those of you tracking regional banks, this call, it felt like a critical data point, especially with all the generalized sector weakness we've been seeing.
That's absolutely right. I mean, you look at the broader regional banking sector, the KRE index, it's been soft lately. Investors are, well, let's just say they're jittery. They're quick to react to any perceived flaw, any slight miss.
So our mission here today.
Yeah, our mission is really to move past that immediate kind of emotional headline reaction. We need to figure out the core tension here. The market seems focused on, let's call it noise, but did management actually deliver a roadmap for, structural profitability?
Right. Are they executing on that long-term goal, becoming a truly scaled $10 billion institution?
Exactly. What are they prioritizing? But do the numbers back up that strategy?
Okay, let's unpack the initial print then. The headline numbers were certainly a bit of a mixed bag, weren't they? And that seemed to set that cautious tone immediately.
Yeah, they did.
So BWB reported adjusted earnings per share of 39 cents. That was actually exactly in line with consensus expectations. But the GAAP EPS, that came in slightly lower at $1.38.
And here's where the narrative seemed to turn negative almost instantly. The market really zoomed in on the top line, on revenue. Total revenue came in at $36.15 million. Now, that missed the consensus target of $36.50 million just by a narrow margin.
Just under $500,000 short.
Right. And look, that figure still represented very solid year-over-year growth, 33.3%. That's not insignificant. But that modest revenue shortfall, you combine it with that generalized sector fragility we talked about, well, it was enough to trigger an immediate reaction.
And that reaction being shares moving down approximately 3.4% right around the time of the report and call. But I guess I have to ask, if the bank hits its adjusted earnings target, why does a relatively small $500,000 revenue miss trigger a 3+% sell-off? Isn't that maybe an overreaction? Or is stalling revenue a legitimate red flag?
Well, that's the core question, isn't it? The market sees sector risk, and it seems to pair it with any top-line disappointment, almost regardless of the magnitude. But if you dive into the core engine of a profitable bank, which is really the net interest income, or NII, the picture looks, well, a lot more constructive. It shows real execution, actually, despite some immediate headwinds they face.
Okay, so let's look under the hood then at that NII performance. What did that show?
Net interest income, the NII, it actually grew by a significant $1.6 million. It reached $34.1 million. Now, that translates to a pretty robust 5.1% quarter-over-quarter growth.
5% quarter-over-quarter NII growth.
Okay. Yeah. But what's fascinating, and maybe what caused some confusion, is that the net interest margin, the NAM, on a fully tax equivalent basis, which is really the truest measure of their lending profitability, that only saw a tiny 1 basis point increase. It landed at 2.63%.
1 basis point. Okay.
And management spent quite a bit of time on the call explaining that this very muted NIM expansion, it was entirely expected. It wasn't a surprise to them.
That 1 basis point gain, I mean, it seems almost negligible on the surface, doesn't it? Yeah. So walk us through the mechanics of that drag. What exactly did management have to overcome just to get that slight positive movement?
Right. They essentially had two major kind of temporary headwinds they had to muscle through this quarter. The first was a substantial 6 basis point net drag that resulted from their June subordinated debt issuance.
The sub debt. Okay.
Yeah. Think of this as a necessary but kind of expensive short-term maneuver. They issued $80 million in new debt, paying 7.625%, and they used that to redeem $50 million of older, much cheaper debt that was paying a 5.25%.
That does sound counterintuitive on the surface. Why take on that higher funding cost right now?
It was definitely a structural decision, a calculated investment, you could say. That immediate margin pain, that 6 basis point hit, it was necessary to restructure their capital base. It positions them to benefit much more quickly, much more aggressively once interest rates really start to move lower. It was an expensive, deliberate choice that caused, a quarter of friction, but it set them up to be strongly liability sensitive going forward. That's the key.
Liability sensitive.
Yeah.
Got it. Okay. Makes sense strategically then. And what was the second headwind?
The second was simply the planned diminishing benefit they get from purchase accounting accretion from past deals. That only contributed 4 basis points to NIM this quarter.
Okay, so less help from that side.
Exactly. So if you net it out, they overcame that 6 basis point drag from the sub-debt swap plus the 4 basis point reduction in accretion benefit just to eke out that 1 basis point overall margin expansion.
Wow.
So the fact that the underlying NII, the actual dollar amount, still grew 5.1% quarter over quarter despite those significant forces, well, that underscores management's execution on the core business, I think.
That provides really critical context for that tiny 1 basis point NAM increase. It actually shows strength in the underlying assets, doesn't it? And despite these high-cost funding pressures, the bank is still building tangible value. That's key for long-term investors.
Absolutely. And that tangible book value per share, TBVPS, it increased to $14.93. That represents a very impressive 20% annualized growth quarter over quarter. That's real compounding value being built, kind of regardless of the temporary in pressure.
20% annualized growth in tangible book, that's strong. Okay, what about the funding side? Deposits.
Absolutely. Moving to deposit performance, the lifeblood of any successful regional bank, this was a major positive standout this quarter. Core deposits saw really strong growth. They were up $92.1 million. That's an 11.5% annualized increase quarter over quarter. Very helpful.
And the quality of those deposits is particularly important here, right? I saw a shift.
Yes, exactly. They saw a $35 million increase in non-interest-bearing deposits, the best kind, zero cost. And that directly offset a similar decline they engineered in higher-cost broker deposits. So that's a powerful shift towards stickier, lower-cost funding relationships. That enhances future profitability potential.
Excellent. Okay, loan growth. Still on track.
Precisely. On the loan front, balances increased by $68.8 million. That confirms annualized growth of about 6.6%. So this keeps them right within their stated mid to high single-digit growth targets for the year.
Okay.
Management did clarify that some expected large third-quarter deals actually slid into the fourth quarter, which, suggests a pretty strong pipeline entering Q4.
Right. Potential for a strong finish to the year there. Now, shifting to fee income. That number declined in Q3, and it was specifically due to a lack of swap fee income. Now, I know management calls this lumpy, but when fee income effectively drops to, zero on a key line item like that, isn't that something of a red flag for diversification efforts?
It's a fair question, and it is a point of vulnerability when it happens. But management was pretty quick to clarify that swap fees are just inherently lumpy. They said it can range from basically zero, like this quarter, to nearly $1 million in other quarters. The average is somewhere around $300,000.
So Q3 was just the low end of the range.
Exactly. And they signaled high confidence in a rebound. They noted they had already booked several deals in October, just after the quarter closed. So that really confirms it was more of a timing issue, deals closing in Q4 instead of Q3, not some structural failure in their fee generation capability.
Okay, that provides some comfort. Now, if we look at the bigger picture of risk, asset quality continues to be a major strength for BWB, which is, I think, essential context in the current environment.
Oh, it remains rock solid. Non-performing assets, NPAs, to total assets held at a very, very low 0.19%, just 19 basis points, and net charge-offs, almost non-existent, just 0.03% of average loans. Really clean.
Yeah. Very clean. They did discuss one specific credit detail, though. The migration of one multifamily loan to substandard status following a canceled purchase agreement. Was this indicative of broader commercial real estate stress?
Management addressed that directly. They were very clear this was an isolated event. It was tied to a specific buyer defaulting on a purchase contract. It wasn't driven by broader market forces or deterioration in the property itself. The borrower apparently remains engaged and is committed to selling the asset quickly.
And the reserves.
Furthermore, they maintain a conservative overall reserve level, the ACL, at 1.34% of loans. And they highlighted the small specific reserve they hold on that one legacy central business district office loan, which, by the way, is now under $3 million in exposure. So the bottom line is there is simply no systemic credit issues manifesting in this portfolio right now.
Good. Okay, let's transition now to the strategic agenda. Because management spent a significant portion of the call discussing operational achievements, things that position them for the future, sort of regardless of macro volatility.
Yes, they did.
They successfully completed the big systems conversion of the first Minnetonka City Bank acquisition back in September. And they also launched a new retail and small business online banking platform back in July.
Yeah, These are critical and often messy infrastructure investments that are now finalized, they're done. And what's really important here for investors is the impact on efficiency going forward.
Right, the expense side.
Exactly. Now that the systems conversion, which caused redundant costs, is behind them, they expect expenses to normalize. They should return to growing more in line with asset growth instead of the elevated growth rate we saw during the conversion period.
That's a key point.
And they're also optimizing the physical footprint. They plan to close one acquired branch in December 2025. But, importantly, they're proactively opening a new de novo branch in the East Metro area of the Twin Cities in early 2026. Now, this is a subtle, but I think a clear signal of confidence in their organic expansion strategy. They're not just cutting, they're reinvesting strategically.
Good point. But the most critical guidance point, certainly for you, the long-term investor, has to be their outlook on net interest margin expansion. They got exceptionally specific about the path forward here, which, frankly, is pretty rare for a regional bank these days.
That's absolutely the key takeaway from the entire call, in my view. Management explicitly stated that because the bank is liability sensitive, remember that sub-debt swap?
Yes.
They are, and I quote, well positioned to benefit from the September Fed rate cut. They noted that a huge chunk, $1.7 billion of their funding, is tied directly to short-term rates. And that includes $1.4 billion of deposits that repriced almost immediately right after that cut.
Wow. $1.4 billion repriced immediately lower.
Yeah. So this means their deposit costs should drop relatively quickly if rates remain steady where they are, or obviously if they decline further.
So what does this structural position actually mean for their NIM target? How specific did they get?
They explicitly outline what they see as a steady, reliable path to reach a 3% IM by early 2027.
3%. That's a big jump from 2.63%.
It is. And they expect this improvement to happen pretty consistently. They talked about maybe 2 to 3 basis points of NIM expansion per month, driven by two things. Loan yields gradually repricing higher as old loans mature, and those deposit costs declining thanks to that liability sensitivity.
2 to 3 BPs a month. That's a clear trajectory.
It's a high conviction promise, effectively. It basically guarantees structural NII dollar growth, almost independent of whether loan volume accelerates significantly or not.
Interesting. They also reaffirmed their ambitious long-term scale plan, didn't they?
Yes. The CEO reiterated the goal of become a $10 billion bank by 2030, and they plan to do that leveraging disciplined organic growth, like we discussed with the new branch, and also selective M&A if the right opportunities arise.
Now, that $10 billion threshold is crucial, isn't it? From a regulatory perspective.
Oh, absolutely. Management knows it. Hitting $10 billion in assets triggers a significant increase in regulatory complexity and cost, most notably the Durbin Amendment implications on interchange fees. So for them to commit to reaching this goal signals, I think, strong discipline. They're planning to manage the growth in a way that maximizes profitability before and after crossing that regulatory threshold. It's not accidental.
And the strategy seems to rely heavily on market share gains too, right? Specifically targeting M&A disruption in their home market, the Twin Cities. They mentioned competitors like Old National and Bremer.
Yes, they see opportunity there. And they're also ensuring continuity internally, which is smart. They announced a very smooth internal succession plan for critical roles like a chief credit officer, chief experience officer, and chief administrative officer. This is really smart, de-risking, ensuring that their critical low-risk credit culture remains consistent, even though some key founders are set to retire in 2026.
Good planning.
Yeah.
Let's also maybe highlight that growth in the national affordable housing portfolio. That seems like an interesting niche.
It really is. It now totals $611 million, and it has grown at a, get this, 27% annualized pace year to date.
Wow, 27% annualized.
Yeah, and this is really a dual benefit growth strategy for them. First, it's an underserved market where they have deep historical expertise going back nearly 2 decades. But maybe more importantly, it's proving to be a significant source of growing core deposit relationships, even with clients located outside the Twin Cities. So it pairs high growth, specialized lending with low-cost funding acquisition. Very smart.
Okay, let's try to synthesize the narrative here then. The market, it seems, fixated on the sector weakness and that marginal revenue shortfall, let's call it the short-term noise, and that resulted in that 3.4% share price dip.
Right. Knee-jerk reaction, arguably.
But management, on the call, they seemed focused entirely on NII compounding, delivering a clear roadmap towards that 3% IM tailwind and executing on key operational improvements like getting that big systems conversion completed.
And this really raises an important question for you, the listener, the learner. This bank seems to be generating its own catalysts, completing conversions, optimizing branches, really setting themselves up to exploit the benefits of being liability sensitive. These are things largely independent of general macro trends. As we said, they stand to benefit structurally if the Fed maintains its current course on rates.
Yeah. And just a quick final note on capital before we move on. Capital ratios remain stable. The CET1 ratio, that's the Common Equity Tier 1 ratio, the key measure of bank stability, actually increased slightly to 9.08%.
Call it.
They maintained capital for growth, didn't repurchase any shares in the quarter, citing that strong organic growth pipeline we talked about, but they still have $13.1 million authorized for buybacks if needed.
Right, which brings us nicely to our segment, This is not financial advice. And let me emphasize, this is purely for entertainment and discussion purposes. It is absolutely not a solicitation or recommendation to buy or sell any security.
Duly noted. Okay, hit us with the outrageous but plausible trade idea derived from this deep dive into BWB's quarter.
Okay, the core thesis here is pretty straightforward. That immediate 3.4% dip, it feels like a classic knee-jerk overreaction. An overreaction to temporary noise, the minor revenue hiccup, the general sector jitters, while completely ignoring the powerful structural shift happening on their balance sheet.
The liability sensitivity and the NIM path.
Exactly. We have explicit management guidance, a roadmap for NIM expansion stretching out into 2027. And we know expenses are normalizing now that the conversion costs are rolling off.
So the inefficiency drag was temporary, but the NIM expansion looks structural and, frankly, pretty likely if the Fed just holds steady or cuts further.
Precisely. So the trade idea would be conceptually a long position in the stock. You're betting specifically on successful execution and perhaps an accelerated benefit from that rate sensitivity. The catalyst timeline is critical here. The bet is that the NIM benefit actually accelerates faster than management's maybe conservative estimate. Specifically, that the immediate repricing of that huge $1.4 billion slug of deposits causes their funding costs to plummet noticeably in Q4 2025 and Q1 2026. If BWB hits that 3% IM target ahead of the early 2027 projection, let's say, maybe by late 2026 instead, then this bank could re-rate significantly. It could move from trading with a general regional sector discount to trading based on its own specific positive execution story.
Interesting. A bet on faster than guided execution of a clear plan. Okay, excellent synthesis. So to quickly recap the key takeaways from the call, we saw a strong core deposit momentum, definitely a quality shift there, a clear high conviction path outlined by management towards that 3% IM expansion target, a very clean credit profile still, and significant strategic progress on systems integration and their $10 billion scale goals.
Yeah. So given the successful systems conversion, the clear scaling strategy, and that explicit NEM guidance, the final provocative thought for you, the listener, to explore is this. Does the current sector softness, the anxiety around regional banks, actually present a unique entry point for long-term growth-oriented regionals like BWB? Could it allow you to buy into what looks like structural profitability gains at a discount caused mainly by short-term broader market anxiety? Something to think about.
Indeed. Thank you for joining us for this deep dive into Bridgewater Bancshares Q3 results. As always, we encourage you to review all the company documents yourself and form your own well-informed opinions. We'll see you next time on Talk Tickers.